Hello traders, hello everyone in TRADEPRO Academy, welcome to our channel and welcome to 2024. In today's video, as you've seen from the title, I'm going to be breaking down my thoughts on the projections for 2024 and how I think this could play out before we get into anything else, right? I want to present this at the beginning of the year so you have an understanding of what I'm looking for, how I'm looking for this to play out, and where we could head into at the end of 2024 and even further beyond. Now, on my screen here, what you have is the S&P. We're going to be going through a few little ghost feeds, meaning that projections on different assets as we go through, and I'll give you some trades that I'm looking at for different types of market scenarios. So if you guys are excited about that, check this out and watch through. Remember, ask me any questions you want. Hit the comment section up, hit that like button, hit that subscribe button, and we'll be back after this intro. So welcome back here, guys, and in front of me on the screen, we have the S&P 500 on a month-to-month basis. Now, we're going to be mainly using TradingView here. I'm going to be breaking down different charts, different symbols as well, going through a plethora of different things. And in front of me right now, we got a monthly chart on the S&P, and at the bottom here, on the orange line, we have the Fed's funds rate. So with the Fed's funds rate, I like to look at this overlay to give us an understanding of what happens generally in the past when we get into a rate hiking cycle or a rate cutting cycle in relation to the market as is. So generally speaking, in the past, when we start to see rate cuts, right, what happens is we see the downturn in the markets and they start cutting very aggressively towards the bottom end of that cutting cycle. So we're now in a pretty aggressive hiking cycle. We've hit a Fed's funds rate of over 5%, just countless hikes over the past year and a half or so. And what's happened most recently over the past few meetings in the Federal Reserve has flatlined that funds rate, suggesting that there have been no cuts, there haven't been any changes, no cuts, no hikes, all that good stuff. So generally what happens when we start seeing a cutting cycle, we start to see the market decline. Now, in a cutting cycle, a lot of people might think, okay, well, you know what, money gets cheaper, right? There's more supply. Why are prices going down? Well, these are in anticipation of a more cataclysmic event that might shape up, as we've seen in the past. When that catalyst hits, the Fed starts cutting pretty aggressively, prompting, right, or not prompting, but kind of lockstep with the market to decline. So as we're seeing, we have expected cuts to come out this year as early as March of 2024 that could go into the end of the year, right? By the end of the year, they're expecting somewhat of around 1% trim of the current rate. The current rate, we'll call it around 5%, just over 5%. They're expecting rates to hover around 4% from the Fed's funds rate by the end of this year, which suggests, right, there is some kind of downside expectancy throughout this year after we had a very solid end to 2023. So what does that mean? What does that tell us? How can we look at this overall market and what can influence, right, these movements? Now, one of the main things that we have to talk about is inflation, the inflationary cycle that has been currently pressing in this market, right? Over the last, well, I guess mainly in 2023, we've seen a very strong decline in the inflation figures, closer and closer to that Fed's target of 2%. Now, I would warn a lot of people that when the Fed sees this, or just generally when we get towards that expected target for the Fed in terms of this inflationary cycle, a lot of people are looking at this as, well, okay, inflation's over, right? Things are going back to normal. The Fed's going to start cutting because the rates are too damn high while inflation is subdued. So they can actually look at this and say, you know what, that's fine. We can continue business as usual and start pumping some money back in this market using some rate cuts. Now, the thing about that is inflation is generally cyclical, right? There are multiple cycles in inflation and there's a bunch of peaks and troughs. Now, should the Fed start cutting a little too soon without real catalyst and without real intervention, what we're going to see is a rapid increase in inflation that puts downside pressure in the overall market, upside pressure in rates again, right? Causing the Fed to kind of step back and would put downside pressure in equities, upside pressure in hard assets and commodities. So Let's take a look at this a little further as we start divvying up some of these assets, right? So the first and foremost, I do want to take a look at the S&P 500, right? I want to look at the SPY and the projection. So I've drawn this little ghost feed to give me a projection of what I think can happen throughout this year to give us more of an understanding of where we stand in this market. So currently, prices are hovering around these highs, right? They're hovering around that 470-ish, mid 470 area. Now, the way I could see this is into Q1, there's a pretty high probability that we hit an all-time high. If we look at seasonality, we look at a bunch of different cyclical movements, mainly seasonality. There's some kind of divot into the end of January, early February, and a peak in March, right? A peak in March, a cyclical peak in March, where I could see that we probably print an all-time high before the first quarter ends, and then we start our steady decline. Why in that period? I suspect that somewhere towards the end of Q1, at the beginning of Q2, what happens is inflation kind of creeps back up and the money manager expectations start getting a little more bearish in the markets and looking for more inflation safe, I guess, assets. So when we see that peak, right, I'm looking for a peak maybe around the 490 on the SPY, somewhere around that 490 as a new all-time high. So we can go and test that in Q1 before we start seeing a little more steady of a decline that brings us into the summer. I think the first major peak to the downside that becomes a dip buying opportunity for the longer term for the swings comes somewhere towards the end of the summer season. Now, I have general targets that are between 380 and 390 on the SPY as a downside move. I know a lot of people are actually looking for it to actually sweep October 2022 lows, which I do believe are, what was it, maybe around 350. There are expectations that we do sweep those lows, but I'm just waiting for time more so. They do well to sweep those lows to get real money back in this market, but I think that we print a higher low, and around that 380, we actually get subdued in August on the S&P. And there's going to be another dip buying opportunity, in my opinion, around that October-November period, as we saw this year as well, before we start the rally into the end of the year into 2025, and we continue that next rip that can last about another year. So I'm fairly bearish once we move past Q1 in this market, and I'm looking for maybe like a 20% downturn in the equity market in the SPY necessarily, and with that you have potential downside trades. So if I'm looking for the acceptance a little lower after that March peak, right, that brings us into a period into about the summer. So you have, let's say, April, May, June, July, and August. So like 4 to 6 months of downside movement that like slowly grind lower before we find that peak lower in these markets and start looking for more stability in the acceptance. And a lot of this is going to be due in part of the Fed starting this cut cycle, as well as inflation creeping up and money actually moving hands from these high beta, right, risk on assets into something like hard assets, commodities, and even, right, emerging markets or elsewhere, right, into foreign investments. So when I look at this, right, the general consensus is that if we get a movement, right, on the S&P 500 down below this 460, 456 area, you get the acceptance of these distributions that have been building out for a very strong, solid amount of time. That could open up this downside move all in all. So as I'm looking at this, I think that there's going to be some kind of pullback that comes out end of January, early of February as a window of weakness that comes down into this low volume area somewhere around that like 460 before we get that push back into a new all-time high. And then after that peaks out, we start to get that decline in these markets. So that's generally what I'm looking at on the SPY, right? Some of these target areas that I do like to see how prices react are going to be down into that 410 again. We have this very large volume block here based on these distributions that sits around this 390. And then down here, it starts to get pretty interesting, right? Once we peak out and we see how this shapes up. Sorry, let me just open this up. Once we come down and explore some of the volume that drops off down into that like 360 area, right? One of the major targets is 340, but that only happens if we sweep these lows, which I think is going to be a lower probability. I think that these areas around 380 to 390 hold the bottom of this current year's downside, which is a very significant move, right? It could be a 100-point mover on the SPY from the upside to the downside, which puts us down about 22% from that peak. So this can be catalyzed by multiple things, but one of the main things that I do want to talk about is tech, right? Tech could bring in this catalyst to actually start moving to the downside, right? Why is that? Because tech is an overcrowded trade, right? The Magnificent Seven, if you will, we'll talk about those as well, but those big tech names have been very oversaturated. Money managers have flown a lot of money into those. And as it stands, what we're seeing is no new inflows of money into those areas, right? There's gonna be inflows into areas that have been neglected, like energy, emerging markets, things like that, commodities, hard assets, things that are, I guess, anti-inflation, if you will. And money is going to start flowing out of the Magnificent Seven, out of the triple Qs, out of the NASDAQ for a larger, more substantial decline. And these individual names are big. What do they call? They're big constituents of these indices, so they have a very strong pull. So if they start dropping more drastically when money gets pulled out of them, these indices are going to suffer and they're going to pull lower. I see a very similar story on the NASDAQ shaping up as the SPY, but I think the NASDAQ has a little more volatility. It's higher beta that we can drop a little more aggressively. 25, 30% is not out of the question for this. But one of my main targets for NASDAQ to the downside is around 295 this year. It's a pretty drastic drop, right? Let's be real about this. Um, if we pull down, right, it's about a 32% drop from the high if we peak around 420, 425 into March before we see that larger decline and rally into the end of the year. Now, it's totally possible if money starts flowing out aggressively from big tech, right? You got to keep that in mind. And one of those things, right, is largely in part due to inflation and the inflation cycle as it comes around and the increase in yields, right? The 10-year yields, bonds are going to do poorly. Bonds and equities have started to slightly lockstep together. They have a positive correlation with one another. But as the bond market fails to continue going higher, right, and is honestly probably going to get reoffered again and sink lower with the rise in yields, what we're going to see is more downside pressure in the equity market, especially as money flows out of these big tech names. So with the NASDAQ, something similar. Into January, Feb, right? I expect to see some kind of maybe pull into that 380, maybe clean up this little gap that shaped up here. And then we can see a little burst back to the upside. And then we start that larger pull down that can bring us into different distributions. One of the main targets I have is around 315, 320, but the main target is around 290 that I have on the NASDAQ, which again, I think shapes up towards the end of the summer. And then you get potentially another chance somewhere into the end of October before we start to see more of a rally that can spark something very big into the end of the year. Now, I don't know if we see a new all-time high or a peak into the end of the year, but I think that we do close the year out strong after about a 6-month window of weakness throughout the year. So am I calling for a cataclysmic downside recession? Not necessarily, more so just continuation of large chop over the last 2 years in the market for a larger pullback this year, which presents us with a lot of dip buying opportunities for the long term, for investments, for swings, maybe back into tech. I think back into tech, you're going to get gifted an opportunity in the latter portion of the year, right? The second half of the year, rather than trying to buy these tops, right? I think that'd be the smarter thing to look out for and the smarter thing to do. If we coast through some of the other ETFs here, IWM is an interesting play because it's a constituent of small cap names, and they're all pretty shitty companies. Let's not lie to ourselves, that don't have that much upside potential, I think, especially for this year. One of my main targets was about 200, 205 on IWM on the Russell 2000, maybe a bit higher before we start sweeping lower. We could see it back into the start of this distribution closer at 215, 210 before downside press comes in. But if we're expecting such a large decline in the overall equity market, I think that IWM is going to follow suit in a more aggressive way where uh, puts on IWM, this quote unquote recession play is going to be one of the larger payers, if you will, as the downside on IWM is going to open up more aggressively with these small caps that are higher beta and are going to get liquidated as well as money starts flowing into other things. So with IWM, I wouldn't be surprised to see this floor break in that 160 as the market pulls back this year. It's one of maybe the only names that actually breaks one of its large levels, I think, at least for the year, where we could easily revisit the 140 area on IWM. So with that, right, with those equities, I think that it would make sense to take a look at the sectors and what some of the plays look like on these sectors. So let's take a look at that. So with the sectors here, you can see over the past year, right, full year, starting at the beginning of January into 2023, you can see which ones have done the best realistically. You have XLK, which is tech. You have XLC, which is communications. Again, a lot of tech names in there, and XLY, which is consumer discretionary. Again, you've got a lot of tech names in there. You've got Amazon, Tesla, Home Depot, McDonald's, Nike, Lowe's, Booking, Starbucks, right? Those are the main names in XLY. And you can see who's done poorly, right? Who's done poorly throughout the year. Utilities at the bottom, along with energy and staples, right? So you can see that there's a big discretion in terms of risk on. Risk on assets did extremely well. Risk off assets generally did pretty poorly. So as we look for money to change hands based on the current monetary policy economic conditions, you're going to start to see a flip in some of these where you start to see the money flowing out of those top three and then start flowing into the ones towards the bottom, especially energy and the commodities. So when you're looking at this, some of this, right, if you're expecting a larger downside move, the recession play is generally looking to short consumer discretionary names and tech, right? So those top three are looked to be short paired with potentially long side in commodities, long side in energy. So I think these start to converge and there's a decent flip and money changes hands as we're oversaturated, especially in those top three, where money managers are going to look for opportunities elsewhere. Now, one of the other main things that we can take a look at here is naturally oil. And oil, it's been kind of steadily just moving, I guess, to the downside over the last few months here. And this might sound very extreme and very crazy, but oil is at a very, very key low area, right? We're at the bottom of these distributions. We're at these cyclical lows as well. And when I'm looking at these oil futures, we're at an area where we're bottoming out into this low 70, right? So my anticipation for oil is that demand starts to creep in. You have a spike in the oil prices, maybe not like 150, 200, as a lot of big banks are suggesting. They're not necessarily right a lot. But what we have in this scenario is that we're bottoming out in oil, and I like it to spike towards that $100 mark into the end of Q1, as will equities, right? Into March, April, stuff like that. I expect to see these guys spike into those areas. And then, right, what that begets is actually increased fears of inflation to start piling back in. So once inflation fears start piling back in, what happens is that there's downside pressure in the markets. There's, again, upside pressure in yields, downside pressure in bonds, right? And upside pressure in hard assets like precious metals and commodities. So with oil spiking, right, that brings inflation back to the table as something to consider and be like, well, what the hell is happening here? And then oil and energy, I think they pulled back a bit into the summer season before really lifting off over the next like 12, 14 months. So when that brings inflation back to the table, when that brings downside in the markets back to the table, you have to look at how the yields are currently reacting as well as bond prices. So if we take a look at US 10-year yields, right? I just type in US 10-year. You can look at like what is it? Yeah, TNX, you can look at that as well. But so I look at these yields, and what we had was a peak into that 5% area, right? Now, What I'm expecting is that yields start to bottom out somewhere in January, Feb, right? Maybe it's at 380, maybe it's at 4. Around this block somewhere, you have a general bottoming in yields. So where is this? This downside in yields has helped the Fed kind of manage without actually having to cut rates. So the downside in yields has really helped the Fed. And I think that the bottoming in these yields presents that opportunity for the market to actually start turning over. So when yields start to bottom, that's when those inflation worries start to come in, and then we start to see yields picking back up, which is going to put some downside pressure in the bond market. Now, if we compare the bond market with the equity market, right, especially the triple Qs, they have a very high correlation here. The draws have widened very, very drastically. So if we take a look at the triple Qs here, and what we'll do is we'll add TLT, right? The 20 plus year ETF on bonds. So we take a look at this, right? And there's generally a positive correlation that begets these assets, right? Let me see, where does it get? I want to see where. Okay, so this is they're pretty close here. So when I look at it in this scale, what happens is, okay, 2022 they pull down, and then all of a sudden into 2023 the jaws start to widen, right? So we get a very strong push in the triple Qs in tech. A lot of money is flowing into these tech assets, these big tech names, and what happens is that prices, or I should say, the bonds, right, the treasuries, they start pulling down a little more aggressively. Into the end of the year, yeah, there's a spike in the treasuries, but you can see they don't get very far. There's not that cohesion, meaning that we haven't seen the treasuries rally like 100% to catch up with the triple Qs. So what's happening here is when these triple Qs top out eventually, there's obviously going to be downside pressure put into the bonds by the rising yields, and then that's going to put some more downside pressure in the equity assets as well to pull not only bonds, but right, the equities lower before we eventually bottom out maybe into the second half of 2024. So all this is shaping up to put downside pressure in this equity market and continue, right, that potential inflation cycle, putting commodities at the forefront, putting equities, right, they're pushing them back towards the latter half of 2024 into 2025, which allows us to not only find opportunities for the short side, but find opportunities for the long side in the second half of the year. One of the other things, right, is hard assets, right? So when inflation starts increasing and we start getting increases in energy, we start seeing oil start ramping up, we start to see energy push up, we start to see money getting pulled out of equities. What happens is generally money starts flying into harder assets like precious metals, right? So there's an ETF, for example, right? There's multiple ETFs on precious metals, but here's a precious metals, physical precious metals basket, right? GLTR, which is one of the examples where we've been in a very, very strong, solid sideways consolidation, where I think, yeah, we might peak a bottom somewhere in January on this next pullback, but I think that names like pullbacks on gold, silver, copper, right, are going to be very attractive, especially as we lead into that dip, potentially into that summer period, where we have a very strong continuation in these commodity assets, right, in these energy assets. So this is one of the things that I do like into 2024. I could see it maybe a dip buying opportunity somewhere in January, but I think later on in the year, there's going to be a much, much better opportunity. So if we look at all of this and we try to break this down, we try to wrap our minds around what the expectations are, what can we look at as trades, areas, and breakdowns of trades considering all of this information? So why don't we pull back the SPY here, and I'll start listing off some assets and some ideas that can present some kind of decent opportunities. So we can split this up in baskets, right? We'll look at the individual tech names as well in a bit, but we can split this off into a few different baskets, let's say. So we expect a peak in March followed by downside, right? If this is to shape up, one of the better plays, in my opinion, at this moment would be something like short IWM, short like tech, whether it's XLK or individual tech names, and then short the discretionaries, right? So this looks like a pretty good play for the downside as we lean into this. You could also be looking at SPY, triple Qs as well to look for the short side on those. Now, another thing I like into that, right, especially into this peak, I like long oil and energy. So we have UCO or options on USO. And also we have the potential longs on quadruple U's, right, an energy name. Now, the other aspect to this is that we have a potential long in precious metals somewhere in the second half of the year. So like ETFs, GLTR, or you can look at silver, right, gold, and copper. Those are some of my favorites when it comes down to this. You can look at copper in terms of ticker symbol TECK, as well as FCX, right, that have been doing pretty well, but I like those. And then we have the second part of the year where we come into the August potential downside leg, August, October downside leg, where I think it presents a very good opportunity, a very nice gift to start getting long specific things, right? Along with commodities here. One of the things that I forgot to mention as well is the forward investments, right? Especially as prices start pulling down towards the second half after Q1 even. Forward investments like EEM, right, emerging markets, and even China, KWEB, look pretty attractive for the long side. Now, if we're considering bottoming in August, right, into November, October, whatever it is, this looks like a very, very good opportunity to start getting back into equities, in my opinion, should this play out, right? You get back into tech, so you can get back into the general triple Q SPY or the names that are within, right? Big tech. I like these areas for investments on the long term as well. You could also look at options. You could also look at leverage like SPXL, along with, I think, commodities and oil, right? Energy are going to still do very, very well leading into 2025. So by the end of the year, if we're somewhere between 450 and 460 on the SPY, I consider this a pretty good year considering what the expected movements are. So as I look at this, right, we can look at some of these individual tech names as well, mainly like Apple, Google, and whatnot, right, from this Magnificent Seven, because names like, what's it called? Names like NVIDIA that have been ripping into all-time highs, it's very, very hard to short something like that unless it starts pulling back a little more aggressively. But names like Apple to target some of these larger distributions down to that 145, 150, right? Looking at these individual tech names, seeing a 20% haircut, right? 25% haircut, I don't think is going to be out of the ordinary. You can see Apple is still very far away from its well, relatively speaking, it's very far away from its all-time highs if you compare it to its other counterparts, being pretty much the largest constituent that we have in the S&P and the triple Qs. It has a lot of weight to the downside. So if tech starts pulling down, especially with Apple here, you have the formation of that downside move that's going to shape up towards the end of Q1 into 2024 before we get that really good dip buying opportunity, again, to reiterate, in August and October for that longer term build. So that's mainly my prognosis. We'll keep up with this as the year breaks down. I just wanted to welcome you into 2024 with some of my outlooks. Obviously, you don't have to necessarily agree with me. These are my outlooks based on the information that I have. And I want to follow through to see how this shapes up and how we present our year, because a lot of people are looking at this thinking they missed the upside. We're going to go up indefinitely. I think there's going to be a really good opportunity to get on the long side for the long term and right swings again, right, that happen later in the year without having to rush into these all-time highs. Remember what Warren Buffett said multiple times: be fearful when others are greedy and greedy when others are fearful. I think those chances when we get 20-30% dips in the market, people get very, very scared and shy away from them, expecting another 20-30 to the downside, expecting some kind of cataclysmic crash to take the S&P down to 0 or 1,000. I don't necessarily see that as a very true reality, at least not this year into 2024. And I could see more upside into 2025 as we start peaking. So as we keep that in mind, I want you guys to keep that in mind, and we'll break down this continuously, maybe on a month-to-month basis. So I really hope you thoroughly enjoyed that video. Let me know if you do have any questions down below, and we'll talk about this a little more. Thank you guys for watching, and we'll see you guys at TRADEPRO Academy.